Interest-only mortgages. Hey, what's going on, everybody? It's Jeff Trevarthen, Jeff the Mortgage Pro. Thanks so much for joining me today. Today, we're talking about interest only as a function of your mortgage and how does that work. But first, if you get a chance, if you would please like my videos. If you like the information that you see, it really helps me out, get my message out to as many people as possible when you hit that like button. And if you like to see these videos come out every Tuesday and Thursday, I would love it if you could hit the subscribe button and get more information as to when these videos are coming out. Usually it's every Tuesday and Thursday. Okay, let's jump into our topic today. We're looking at interest-only mortgages. So traditionally, when you have a mortgage, whether it be a 30-year fixed or an ARM loan, you've heard all these different types of products that are out there. They're both principal and interest payments, okay, on your monthly payment every single month. But with an interest-only mortgage, you are only paying the interest portion of that mortgage. So think about this for a second. And this is why I like these types of loans at the end of the day. And if you're gonna, put a penny into your mortgage payment, there's only two ways that you can get that penny back. The first way is that you could sell your house, and that's how you could recoup that penny, assuming that the property has gone up in value over time, which may not be the smoothest and easiest way to get your money back out of that transaction. Or the other way to get your money or that penny back out is if you were to refinance or borrow against your equity on that home. Now, everybody knows that if you're going to borrow against your equity, you're most likely going to have some sort of an interest expense that's associated with that. So you're going to be borrowing money that you had as liquid cash because you put it into your mortgage at the end of the day. So what I'm getting at here is that when you make an interest-only payment, there's several benefits of why I think this is a really good option for those of you who can qualify for this type of a loan or this type of a function on your mortgage payment every month, okay? So the first one is that this is typically the lowest payment that you could possibly make on your monthly mortgage. And if you've watched my channel enough, you know that I'm a big proponent of cash flow. So cash flow in the terms of whether it be coming from your monthly income coming in and your expenses going out. This is going to be the lowest expense on an interest-only mortgage that you're going to have for your mortgage payment, is to have an interest-only feature on your mortgage. Okay, so cash flow is really important in that sense. And then if you were like an investor and you had an interest-only mortgage on there, chances are that that would be the lowest payment that you could possibly make, which means that the income coming in or generated from your investment property is also going to be maximized when you have an interest-only product on your mortgage. So really, really good because that's going to be the lowest payment you can possibly make. So lowest payment, again, just to reiterate that fact, means the best cash flow that you're possibly going to have on that type of a property. One of the things that you may not know, or maybe you do know, is that values tend to go up way faster in terms of appreciation than they do by paying principal down on a loan. So take your mortgage statement, figure out, this is an exercise you could do to figure out how much you've actually paid down on your loan. You know what your original loan balance was, but look at your mortgage statement and see how long it's taken you to pay down the principal that you have on your current loan. Most mortgages are structured so that the first 10 years or so of a payment plan on your mortgage is going to have mostly an interest-only expense anyway. You're going to be paying mostly interest for the first 10 years on your mortgage loan. And as a matter of fact, I don't know very many people who pay off their mortgage loan over the long term. So this could be a good way for you to definitely help improve your cash flow. The value here is that you are going to accrue equity faster just via appreciation than you are by paying down the principal balance on your loan. So with an interest-only payment, you're going to have the lowest possible payment that you can possibly have. And then lastly, you're maximizing your tax benefit, if there is any, that you can have on a particular loan, right? You don't have any income tax benefit for paying principal down on your loan. You only have the interest expense that you can maximize as your tax benefit. So when you're paying just interest, you are fully maximizing that tax benefit on there, even though you're not paying down any part of a principal balance. Okay, so these are some of the things that I love about interest-only features on loans where you're paying just interest only. I really like the cash flow portion. That's my favorite thing that there is about these interest-only mortgages. Here's what I don't like about these mortgages, and it might sound like I'm I'm trying to get at that this is a really good product because I think it is, but only these types of features are reserved for jumbo loans and non-QM mortgages, which means those are going to be a little bit harder to qualify for anyway. And the normal borrower can't usually get one of these types of loans. Like if you're a low down payment borrower, if you have low credit scores, or you don't have much money in reserves, you're not going to qualify for an interest-only loan. So I don't like that about that it's not available for most people, and most of the population could get this feature and maximize their cash flow that way. So I do not like that about that. Banks have made it so hard to qualify for these things that only the top echelon of borrowers are able to qualify for these interest-only loans. So for example, you usually have to have a minimum of 25% down, but more like 35% down is what we're looking for when we're doing interest-only loans. 700 minimum credit, but more likely like 740 or above. And then debt ratios definitely have to be below 43%. And then you're qualifying on a fully amortized payment versus just the interest-only payment for the most part. There's some investors out there that allow you to qualify on just the interest-only payment as long as the term is 7 to 10 years long. But for the most part, we're always going to have to qualify with the highest payment just in case you had to make the highest payment possible. And then there's usually big reserves that are required for these types of loans, like 18 to 24 months when you have an interest-only feature on your loan. So at the end of the day, I don't like how it's not really available for everyone. I think it's a very useful tool to use in your mortgage. If you're able to qualify for an interest only, it may be something worth looking at. As always, what I would say to anybody too is just make sure you run the numbers. Like there's times when an interest only payment is actually going to be more than a fully amortizing payment, and we would definitely not want that. Okay, so make sure that you always run the numbers first on whether you get this interest only feature or not. If you have any questions at all, please feel free to reach out to me. What I'll do is I'll put my Calendly link down below in the description, and I'll also put it down below in the comments. So if you'd like to talk to me about interest-only mortgages or any type of mortgages that you have, I'd love to be a resource for you, and I look forward to seeing you guys on the next show. Thanks for watching.